Something happened with Tesla stock recently that now makes it one of the best passive income opportunities in my entire portfolio and possibly even in the entire market. I know that sounds crazy because Tesla does not even pay a dividend and it will probably never pay a dividend, but that does not change the fact that something happened to Tesla stock overnight that suddenly makes it such a huge income opportunity for a lot of investors such as myself that just did not exist before. This is a brand new opportunity. I jumped on it as fast as I possibly could and I generated over $4,100 in income. I plan to continue to take advantage of this opportunity for as long as it lasts and hopefully generate thousands of dollars in passive income every 30 to 45 days. But I don't think the opportunity is going to last that long, so I'm just going to take advantage of it for as long as I can. I'm breaking down today's video into 3 sections. In section 1, I'm going to tell you why is a dividend growth investor such as myself even talking about a non-dividend paying growth stock like Tesla in the first place. In section 2, I am going to tell you what the heck just happened with Tesla stock that suddenly put it on my radar and made it a huge income opportunity for a lot of investors that just did not exist before, including myself. And in section 3, I'm going to tell you exactly what I did. I'm going to show you my screen and I'm going to show you how I took advantage of this Tesla income opportunity and how I plan to take advantage of it for as long as I can, hopefully every 30 to 45 days or so until the opportunity just does not exist anymore. Before I get into all of that though, please, if you are finding any value in these videos at all, give us a thumbs up, give the video a like, subscribe to the channel, tap the notification bell. All of that will help us to continue to grow the channel and to continue to hopefully keep putting out content like this. So getting back into the Tesla income opportunity, I have a question for you. Is there any role at all for a non-dividend paying growth company like Tesla in a portfolio that is focused entirely on building and generating passive income? In other words, is there room in your portfolio, if you're an income investor, for a growth stock? I would say absolutely yes, there is, and that is based on my own personal experience. So my portfolio right now is valued at around $3 million. That includes real estate, that includes stocks, that includes bond funds, and that includes my option contract obligations from selling options. And so it's about $3 million. I did not start off with a $3 million portfolio. I scaled it. It wasn't really until I started investing in growth companies that it really started to balloon. And by growth companies, I mean both private, such as my own companies, and public, such as stocks like Alibaba, Amazon, Nvidia, Apple, Microsoft, and now Tesla. So for me personally, growth has played a huge role in scaling my portfolio. Now, I am primarily an income investor, and so how I use growth to grow my income portfolio and what I'm suggesting here in this video today is that there is a role for growth stock. Not everybody has the opportunity to or the time to start their own private company, but everybody has the opportunity to invest in publicly traded growth companies. And here's the strategy that I use. This is how I use growth and how I've used growth to scale my own personal portfolio to around $3 million. I allocate a portion of my total investment portfolio just to growth with the hope that my growth portfolio just blows up and balloons and the total value becomes a lot bigger than what the value would be if I was only investing in dividend paying stock. And so I blow up the portfolio in a good way, blow up. I balloon it. How about that? I balloon the portfolio and then I sell off part or shares of the growth part of the portfolio. And I take that money that just ballooned and I reinvest it into the income portion of my portfolio. So the stocks or the securities or the funds that pay income. So that is how growth fits into my portfolio. And that is why I'm talking about a company like Tesla, because Tesla Tesla, obviously it is a growth company. It is actually, to be completely honest, it has never, ever been on my radar as an investor for a couple of reasons. One, primarily I'm a dividend growth investor, and so I am investing in companies that make money and then that share a portion of that money with their shareholders by way of a dividend that grows as its profit grows. Well, we know that Tesla just recently started making profits. It just recently started making money, and so it didn't even have an opportunity to pay a dividend. So I wasn't really interested in it that way. But even that it's making money, it doesn't make any sense for the company to pay a dividend. It's a growth company. It's trying to change the world. It needs all the money that it makes to reinvest in itself and to finance new projects and even existing projects. The other reason why it wasn't on my radar is because I will sell options on growth stocks like Alibaba. I've sold an option on Alibaba. I've sold a few of them, call options on them for high income. Just a couple months ago, I sold a covered call option on Nvidia that generated over $6,000 in income in a single payout. So why did I never sell an option on Tesla? By the end of August, Tesla shares had climbed to around $2,000 per share. I think they even hit like $2,300 per share or so. So I only sell covered options. So if I'm selling a put, I'm only going to sell a put that is cash secured, meaning I have the cash in my account to cover my potential purchase obligation if I input shares and if I have to buy the stock. So if I'm selling a put, it's always covered. If I'm selling a call option, I always own the shares that I'm selling the option on. And so it's covered by the shares. Well, Tesla at $2,000 per share, how much would I need? And because every option obligation, every option contract involves 100 shares of the underlying stock. And so if I'm going to sell an option on Tesla, I need $200,000 to cover that. And I'm not counting any premium that I get, and I'm just assuming that the strike price is at the money. So if my strike is at $2,000, Tesla's trading at $2,000 per share, I would have needed $200,000 just to make one option play, on Tesla. And $200,000 out of $3 million portfolio comes to a 7% position. I have a rule of thumb that my position sizing, especially on a stock such as Tesla, it is under 5% or under. So 7% broke that. I would absolutely be comfortable 7% with a company like, Apple or Microsoft or even Amazon. But with a company that has a PE ratio of over 1,000, I'm just really keeping it safe under 5%. And so because of the share price of Tesla reaching $2,000 per share, I had it just wasn't feasible and it wasn't responsible of me if I were to make a play and all of a sudden I had a $200,000 position in Tesla. So I passed. But something happened recently, and if you follow Tesla, then you probably know what happened. The stock did a 5-for-1 split at the end of August, early September. I think it was the very end of August. And so as soon as the stock split, overnight, shares were trading for around $440. I jumped on the opportunity within a couple days, and by the time I made my trade, shares were already trading down. They traded down to $390 per share. So now all of a sudden, Tesla became a fantastic income opportunity for me because growth stocks like Tesla are incredibly volatile. They are high beta, and in the options world, the more volatility a stock has, the higher the premiums are that the option buyer has to pay and the option seller, like me, gets to collect. Here's the exact trade I made and 2 different ways the trade could play out. The date was September 4th, just a few days after Tesla's historic 5-for-1 split, and Tesla was trading for $390 per share. Just to give a little idea about what's going on in my head when I'm looking for a setup, here is what I'm thinking. Sometimes when I'm selling options, especially on a stock that has some volatility and that may be hard to value fundamentally, I use basic technical analysis to help me figure out my setup. In the case of Tesla, I figured that the stock had some nice price support at its 50-day moving average, which is around the $350 level. And so I used $350 as the strike price. I also chose a relatively close expiration date because on a growth stock like Tesla, I'd really prefer not to be in the trade through earnings. I like a little volatility, but honestly, with Tesla, the stock could absolutely soar or it could absolutely tank after its earnings. So to just help manage risk a little, I chose an expiration date before its next earnings release. So for my trade, I ended up selling one October 16th, 2020, $350 strike put option for $41.72 per share. And there are 2 likely ways this trade will work out. On one hand, I'd get to generate a 103.7% annualized yield from Tesla without even owning a single share of the stock. On the other hand, I'd get paid to buy Tesla at a massive discount to what it was trading for at the time I executed the trade. Here's a closer look at how these scenarios will most likely play out. Scenario 1, Tesla falls below $350 by October 16th. If Tesla falls below $350 by October 16th, I may be obligated to buy 100 shares at $350 per share. That's cheaper than the $390 price the stock was trading for when I sold the put. In exchange for my agreement, I was paid an instant $4,172, which is the $41.72 in option premium times 100 shares. This money was deposited immediately into my 401k retirement account at Fidelity. Taking this income into consideration, my cost basis on Tesla would drop to $308.28. That's a 21.1% discount to the $390.88 share price that Tesla was selling for at the time I made this trade. So in scenario 1, I get paid instant cash while waiting to buy Tesla at a discount. Scenario 2, Tesla stays above $350 by October 16th. If Tesla stays above $350 by October 16th, my option contract expires worthless and I get to keep the $4,172 in income. This works out to an 11.9% return in income on what my purchase obligation would have been, and it happens in just 42 days. If I can repeat this kind of income trade every 42 days over the period of a year, I could generate a 103.7% yield from Tesla, and that's a stock that doesn't pay any dividend, and all of that without ever even buying shares. So this is one way to trade Tesla for high income. Like I said, this kind of opportunity wasn't feasible for me until the stock split. Pre-split, I would have had to have around $200,000 invested in Tesla, which was too high a position size for me. But post-split, and considering the strike price I chose and the premium I collected, my purchase obligation is now less than $31,000 if I'm put shares. That's only 1% of my portfolio. Considering all the income I can collect from Tesla by selling options like this, and considering how the risk to my portfolio is basically 1%, and that's only if the stock goes to zero, I think this is a fantastic combination of risk to reward for me personally. Everyone is different. I also realize that obviously not everyone has a $3 million portfolio to deal with yet, so even after the split, the kind of income trade I'm showing you still may not be feasible. But again, I'm just trying to be completely transparent with the moves I'm personally making in my portfolio, and if there's anything at all that I can share with you about things I'm doing to help you in your own journey to generate streams of passive income, well, that's why I'm doing this video, and I hope it helps. All of this said, I do want to throw out a possible strategy you could do that essentially imitates my income trade, but it lets you do it on a smaller portfolio. It's called a put diagonal debit spread. I know that sounds confusing, but here's basically how it works. The main problem a smaller portfolio would have with the trade I did is how much cash you need in order to secure the trade if the contract gets executed and you're put the shares. If you imitate my trade, you'd need $31,000 in cash in your account for this one single trade. If you don't have that, one thing you may be able to do is 1, buy an in-the-money put option with a longer term expiration, and then 2, sell an out-of-the-money put option with a nearer term expiration. Again, to be completely transparent, I've never actually done this. I've always covered my options trades with cash or shares, but the put diagonal debit spread could be a way to achieve similar results to what I'm getting, but just geared for a smaller portfolio. Guys, that concludes today's video. Thank you to anyone that stuck through it. If you got any value out of this video, please give it a thumbs up. Please leave a comment that lets me know what you didn't like about it, what you did like about it, what you want to hear about in the future. Share it with your friends if you think that anybody else could benefit from it. And be sure, if you're not subscribed, subscribe. If you are subscribed, but you don't get the little notification from us when a new video gets posted, then tap the notification bell. If you're logged in on your phone or your tablet or your computer, then YouTube will let you know as soon as we publish a new video. And so, as you know, every single week you are getting a high quality dividend growth stock that is trading at a reasonable price, which is fair value or better, from Jason Fieber on this channel. So every single week you are getting an investment idea that you should consider if you're a dividend growth investor. I personally watch these videos and I look at Jason's ideas and I invest in a lot of the ideas that he is covering. If you want to know what Jason is investing in his own portfolio, then I will put a link to his Patreon below. Any patron that signs up gets immediate access to his entire portfolio. They get alerts whenever he buys or sells one of his stocks. He doesn't sell very often, so he's mostly buying. And for me personally, that's a fantastic resource. course, I want to know, what is Jason buying? Because I really value his analysis, especially in the dividend growth investing space. And so that is it, guys. I will talk to you soon next time.